welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 187. On today's episode, we're going to talk about decision-making in uncertain investment environments. We'll talk about the U.S.-Iran war, and we'll also talk about annual reports. There's all kinds of annual reports coming out from all the companies discussing what they did last year and what they have going on this year. So we'll talk about how to read through those, things to look for to make you a better investor. So as always, get your mind right and let's get to work. Well, welcome back to the show, everybody. Man, what a difference a week makes, huh? So we have seen just a dramatic reversal. So the month of March was, I believe, the worst month for the market in 3 years. And then now we see April. There's been a dramatic recovery. You now have every index up for the year. So the NASDAQ is up about 5%, S&P up about 4%. And Dow Jones at about 2.8, so very close to 3% that it is now up for the year. And we've had this dramatic reversal of we're worried about everything, and the war is going to tip into this big global thing to now we're not worried about anything. They say the Strait of Hormuz is open. I don't know if anybody believes that. I've seen these great memes this weekend that say the Strait of Hormuz is only open from 9:30 to 4 Monday through Friday. And if you don't get that joke, well, I'm sure you're listening to this, you probably do. But if you don't get that joke, that is because that's when the stock market is open. And so, we just go from this huge wall of worry to everything is going to be great. I'm not really sure the optimism should be. I mean, maybe we shouldn't be that pessimistic. Maybe we shouldn't be this optimistic. But it is an interesting reversal. And of course, we will see what happens this coming week. I'm recording this on April 19th. So it is a Sunday. But one of the things I wanted to talk about today was I had somebody this past week ask me about, different characteristics that I thought made good investors or bad investors or whatever to try to help performance. And one of the things that I was thinking about was that kept coming to my mind was decisiveness, or if you want to look at it the other way, is indecisiveness, which is the inability for a lot of investors to be able to make decisions. And to be able to make decisions quickly, I guess, is the other thing that is important here. And, not just for your investing life, but your other areas of your life, being able to make a decision and not be like, I'm just going to think about this for a little bit, is one of those crucial things that you have to get a little bit better at in being able to make a decision, go through with it. And then, if you have to make another decision later on, but this stalling out, not making a decision, just over analyzing things over and over again. You got to be able to make a decision. And that is so key when it comes to investing as well. So we've talked many times on this program that most of the best days in the stock market happen within 2 weeks of the worst days. And so often there are times where we need to be making the decision to buy, invest more, and we're scared. That emotional piece just kind of really, really hurts us. And so this past week, this is kind of annual report season. So I'm getting just literally annual reports every single day. The mail lady is not happy with me. She keeps filling the mailbox every single day. And I've been going through these all weekend. I think I've read through like 35 of them this weekend. And yes, I am a nerd. I do go through these annual reports, and I'm not the smartest person, obviously, but I do have a good memory. If I have like any kind of, special talent, I'm going to say it's my memory. And so year after year after year of reading these annual reports, like I have like on the same companies, like I start having this, I can recognize certain things. I can remember what they put in there last year, what they did in this past year. And so I'm reading through these annual reports, and I promise I'll tie this back to the decision-making process. But it's so enlightening to read these annual reports and to see what companies are working on, read their letter to shareholders. That is the number one thing that I start off with, is reading the letter to shareholders. And it will surprise you how many companies don't actually do a letter to shareholders, which to me is a pretty big, I don't know, warning sign if they don't write like a letter to shareholders letting them know. Because usually the letter to shareholders is going to say, this is what we did this past year. This is what we're working on. These are the things that we as a company are trying to do to help increase your return as a shareholder. And this is what went well. This is what went bad, which most of the time they don't tell you what goes bad. So we'll talk about that. But then just to not do a letter to shareholder, for some reason, I'm going to get off my soapbox now, but it really bugs me because there's big companies that do it. Like this year, Ford, there's no letter to shareholders, which is usually the CEO taking the time to write a letter saying, like I just said, this is what we're working on. Ford's a big company. They should be able to do this. Former CEOs of Ford did do this. And I went back to look. I was like, geez, I know I remember reading these. And yeah, no. And there's a lot of different stuff going on at Ford where they're getting rid of the EV strategy or whatever. So you'd think they would take time to notice. But I was reading through some of my favorite companies. Here's, you can't see unless you're watching this on video, but here's Cummins. And then I brought up, here is Cummins 2024 report, because I keep them. And there was a big thing that Cummins was working on where it was this new engine. And I thought it was interesting because in this year's report, in the last couple of years, they had a thing called Accelera that they were working on, which was just a new type of engine and business that they were working on. And in the last couple of years, they would dedicate almost a whole paragraph to how this was going. And this past year, they started pulling money from it. And so they went from paragraph after paragraph to this year just basically doing a one-line item saying that they're curtailing future investments, which means they're no longer going to be investing in it. And I just thought that was interesting because it's like, man, you'd think that people aren't going to notice, but they do. And so one of the things when you go through annual reports, if you're reading through some of these, notice how many of these businesses, or a number of these businesses, they do tell you what's going on with the business as far as what's working well, but few of them are willing to tell you things that are going wrong. I just noticed that this past year, like Tractor Supply was another one where their sales only increased 1% and they're talking about how good the business is doing. I'm like, that doesn't sound very good. Or some of the home builders, and they're talking about how, and I'm like, home building is not in a good place. Like so many of these businesses where they really just, I don't know, like be honest a little bit. Some other ones here that I liked. One that we haven't talked about hardly at all. I don't know if I've talked about it ever on here. Is Lumen, which is an older company. And if you go read their, letter to shareholders from their CEO, I thought it was one of the best ones I read as far as a CEO being honest, talking about doing a turnaround strategy, talking about the different things that they were working on, talking about selling off business segments to pay down debt, which allows them to have a better opportunity in the future. I thought that one was really honest. AMD is another one that I thought was really good. AMD, if you look at their report, you look at AMD, which too bad I didn't do this 2 weeks ago before the stock, really, it's jumped probably 20% in the last, 10 days. But they talk about how right now their earnings per share is like $2 a share. And they're expecting that to go to an annual earnings per share of greater than $20 within the next 3 to 5 years. The amount of growth that AMD is seeing is something to behold. And so one of the assignments that I give in my investments class and then some of my graduate programs is I have students design a $100,000 portfolio. And in that portfolio, I want them to come up with individual stocks that they need to invest in. So, not ETFs or whatever. Now, they might think that I'm pulling this number out of a hat, but if you've listened to this for a little bit, you'll know that the hardest number for somebody to hit in their investment portfolio is $100,000. And so I want them thinking about that $100,000 number. But more importantly, I want them to be thinking about the investments that they would want to own if they had 100,000. Now, this is a game plan because most people are not going to start off with a big lump sum of money that they get to allocate. They are going to start saving every month or every 2 weeks or whatever it is to build up their portfolio, which is what most people are doing. And so in order to do that, though, you have to have a game plan and you have to have an idea of the companies that you would want to invest in. It's the see it before you can achieve it method. And so you have to have an idea. These are the companies I want to own. I might not have that portfolio yet, but this is the portfolio that I want. And then start doing your homework on those companies, reading the annual reports, looking at the numbers, doing all the things, knowing this is a good company so that when the market is going through what it's gone through over the last, 4 to 5 weeks, you can then take advantage of knowing you have to have already done the homework so that you can make these decisions in real time and quickly so that you can take advantage of other people's emotions betraying them. And so that is like kind of the lesson here is that in order to be decisive and to make decisions quickly, especially when it comes to investing, you have to know that the company that you're going after is already a good company. You can't start doing the research when there's a breakout of war somewhere or there's a conflict somewhere, but because it's going to be too late, you're going to miss it. You're not going to have enough time to take advantage of that. So with me reading all these annual reports and going through all these company financials and really having this playbook in my mind, basically, of companies that I want to invest in for me or clients or whomever, like I keep up with the homework so that when other people's emotions are betraying them and they're selling out, and I think about that statistic that the market, most of the best days in the market happen within 2 weeks of the worst days. I'm thinking about these things so that when those worst days happen, I can take advantage of them. And believe me, one of the things that I'm seeing in all these reports, this one's Charles Schwab, and Charles Schwab is talking about how everybody, there's a lot more young people that are investing, so that's good. But one of the statistics in their annual report that really stuck out to me was that Charles Schwab talks about how much activity has increased on their platform, trading volume. And so you look at that and go, wow, that's good for Charles Schwab. But here it says that their trading volume was up 31% over 2024. And so you read that and you might think, ooh, that's good for Charles Schwab. But I'm reading it going, man, that's a lot of people trading their accounts. And so if all those investors are trading their accounts, increase of 31%, those probably aren't all just buy orders. Those are probably a lot of sell orders with people churning their own accounts. Churning is when you buy and sell stock a lot. A lot of investment advisors used to get in trouble for that. Now, individuals who aren't working with anybody do it at will on their own. So I'm looking at that going, man, 31% increase in trading volume. That's happening on a lot of other platforms. Morgan Stanley has E-Trade, same thing. Robinhood, same thing. This trading volume. You look at Goldman Sachs, when they do their quarterly reports, they're saying, oh, we're seeing an increase in trading volume, which is, you would think that these companies say, hey, you got to take advantage of the market's moves. You got to, do all these things. But really, sometimes that trading volume, that increase in activity is not a good thing for your portfolio. So I read that and I think to myself, okay, there's all these emotional traders out there that are going to make mistakes on their portfolios. I need to make sure that I have my playlist ready of the companies that I want to invest in. And so I got to be ready to take advantage of them when that happens. And so that's what I'm reading all these annual reports, looking at that, building kind of the database in my mind of companies that I want to invest in. So I read all these annual reports. I put, some in a pile that are, terrible, some that are okay. And then, man, these are companies that I really want to go look at more. I want to do more homework on them. One of those would be one of the best reports I've read so far is GE Vernova, and just the amount of power that we're going to need in the next 3 to 5 years. And especially, as we go into the 2030s, man, that seems weird to say that, 2030s. But GE Vernova was pretty amazing. So there's just good companies out there that you really have to hone in on. And then there's other companies who, they're okay, but they're not thriving. And the other thing that was interesting I've probably read, I don't know how many, 35 of these so far. The number of them that are talking about doing AI is woven through all of these. But some of them, you'll notice that, yes, they talk about doing AI. Some of them actually tell you what their AI strategy is. So they say, this is where we're implementing it. These are the segments of our business. This is how we're going to implement AI. So we're getting much different from some of these companies who just use the word AI, hoping that it's going to get, their stock's going to jump a little bit, to where we're starting to see companies actually lay out their artificial intelligence strategy, which I think is going to be another differentiator between some of the companies that win and some that don't. So think about this. Think about the companies that you want to invest in. Think about, design the portfolio. Don't think about the portfolio you have. Think about the portfolio that you want in the future. And think about, okay, this is where I want to get. These are the companies that I want to own. Do some homework on these companies, read about different companies. And then that way, when you have the volatility that we've seen last year at this time, this year at this time, there's usually going to be one or two events a year that raise the volatility of the stock market that you might be able to take advantage of. Now, I'll agree that under Trump, that number's probably double than what it normally is, or triple. But there's going to be geopolitical things. There's going to be certain things about once or twice a year that is going to increase the volatility of the market. And then all of a sudden, you have your opportunity to maybe invest in some of the companies or buy more shares in the companies that you're really interested in. And so you have to just kind of keep that top of mind, keep the emotional part down of seeing the stock market drop. But it really does help, and it helps incrementally over time. It's the consistency of reading these and looking at these and following companies. It's the consistency of that's going to help you really outperform over time when it comes to looking at your portfolio. And you'll see it right now. We have companies reporting earnings. We had the banks this past week. That was something else that I think has kind of stabilized the market, where these companies are saying, hey, the consumer's resilient. We're not really seeing a whole lot yet as far as consumer behaviors changing. So that also steadied the market a little bit. But I mean, I think too, man, the fear of missing out, that FOMO strategy, the fear of missing out, so many of these investors that sold, you get a little bit of good news that maybe the strait's open or that this conflict's going to come to an end. And man, you just see that money rush right back into the market. And now all of a sudden, S&P's at all-time highs, NASDAQ's back to all-time highs. I mean, it's amazing how quickly that money comes back in. So, you never have as much time, and I'm as guilty as this than anybody, but you never have as much time as you think to acquire shares when the market's down. And obviously, if you had a crystal ball, you'd be a lot more aggressive. But you look at this and go, man, these prices have recovered a lot. And so you got to kind of be careful that you don't chase while everybody else is chasing. So I know that's kind of talking out of both sides of my mouth, but you have to look for those opportunities and then be careful when all the money comes back in that you're not just kind of chasing everybody. There will be some news story that I don't think this is going to be a straight line from we had the Iran conflict and then all of a sudden it's over. I think this could definitely take a few more months. So just kind of wait for some of these bad days. The NASDAQ has been up 13 days in a row. The last time that happened was 1992. So, we went from a market that was very much oversold, and then we have completely reversed that to a market that's a little bit overbought. So just be careful that in the euphoria that you don't chase things up. And at the very least, if you're investing, you're doing things, and there's some negativity and the market starts to pull back again, don't sell into fear. I've used this so many times. I think about this all the time. I know I've used it on this the show a lot, but, Warren Buffett, Charlie Munger, they used to have these conversations when the market was doing bad, and they would always ask each other, like, what's the dumbest thing we can do right now? And usually the answer to that was sell. So even if you're not actively investing, purchasing, just don't sell into any of the fear because usually, 9 times out of 10, you're going to live to regret that one for sure. So hope this has been helpful for you. Go look at some of the companies that you've invested in. I have the physical annual reports here, but every single company that is a public company, you can go and you can look at their annual reports online. Just type in the name of the company and then type investor relations after that. And they will have a website dedicated to those annual reports. You can look at probably years past on many of them and start to compare. It's one of the best things you can do, especially as a new investor or new to a company, is go read the last 3 years, go see if they have a letter to shareholders, read the last 3 years and see if that company is working on things, if it has stuff that you're hoping to invest in that you think is going to provide some growth and the trajectory that you want. So as always, don't mistake activity for achievement, and we will see you next time. Thanks, everybody. This podcast contains general information that may not be suitable for everyone. The information contained here should not be construed as personalized investment advice. There is no guarantee that the views and opinions expressed in this podcast will come to pass. Investing in the stock market involves gains and losses and may not be suitable for all investors. Information presented here is subject to change without notice and should not be considered as a solicitation to buy or sell any security. Right or Equities does not offer legal or tax advice. Please consult the appropriate professional regarding your individual circumstance. Past performance is no guarantee of future results.